what makes them tick, and you really learn it at a ground level. We do field audits, we met with management teams. There's a lot of due diligence involved. So that was a great start as an investor. Got me thinking. But I always my passion was always with investing, and so even when I was a banker, I would write financial columns for different financial papers, and I was a big fan at that time, even of Buffett and Munger. And so eventually I started my own newsletter in 2004. And that was a great thing to do. I started just as kind of at nights and weekends kind of hobby, where I'd write about different stocks, and I had a portfolio where I'd track the results for people. And that did really well. And so I was able to quit banking. I did the newsletter full time and got to travel all over the world. Been to Dubai many times, been lots of different countries, learned a lot about investing all over the world. It was a great journey, met all kinds of interesting people. And my publisher, I published some of it myself for a while, and then I made a deal with a publisher in Baltimore called Agora. That's how I met the Bonner family. And so in 2016, I started to work more closely with the Bonner family office and help them invest in all kinds of different things. And that eventually led us to thinking about, well, maybe we can open this up to the public more, what we're doing. And there were a lot of iterations along the way, but ultimately what I designed was a fund, and I pitched them the idea of that in summer of 2018. And we called it Woodlock House because it's the name of a property they own in Ireland. It's been there a long time. And when I visited them in Ireland, that's where I made the proposal. So it seemed good to name the firm after that. So Woodlock House really grew out of that idea. And our idea was to create a vehicle for our families, basically, that had a long-term horizon, that could really invest thinking out, a decade or more, and not be subject to the kinds of pressures that a lot of funds have. So when I created Woodlock House, I asked them to seed it with $25 million, and that's what they did. And so in the beginning, we opened our doors in 2019 with the Bonner family, my money and one other investor, and so far it's been a good journey.
Great. So can I say that 20 years before, you had no idea that you will end up like a multi-bagger stock when we buy it, and 20 years down the line, we don't even know that it become 100x. Is it something like that?
That's it. That's something like that. I mean, I never really, it's not like I started out with this idea that I had to be a fund manager. I was just fascinated by investing and learning about businesses, and my path just sort of unfolded organically, just kind of followed my interest. I mean, I had opportunities to manage money while I was doing the newsletter because the newsletter had a very good track record.
Yes.
That's partly why I started with the Bonner family offices. They had the best track record of anything they published, and they published, 100 different newsletters or something like that. So, but I didn't want to manage money in the setting where, I had to be one of those guys who spends 80% of their time trying to raise assets, or, I didn't want to do it that way. That's why I did it with the Bonners, because they're a perfect partner. They think the same way I do, and they were able to give me that anchor capital, so I could really think long-term and not worry about, if I didn't raise any money, it'd be fine. I would just be managing the Bonner money and myself. But as it happened, it worked out quite a bit better.
Okay, great. So now you talk about your investment philosophy, which I think you have named CODE. C for cheap, undervalued asset. O for owners, managers with the skin in the game. D is for disclosure. And E is for the excellent financial conditions, the companies with low financial risk. Now, I'm very intrigued about the C, which basically you mentioned about cheap. Looking at the companies which you have bought, like Copart and Evolution Gaming, I don't know how you find them cheap. I want to understand, how do you fit them into your C of the code?
All right. Well, that is an excellent question. And, my thinking on cheap has evolved over time. So when I started studying investing in the 90s, probably like a lot of people, you start with valuation as being very, very important. And you want to buy like low price to earnings ratios, and you look low price to book, and you want dividend yields, and you look at those traditional metrics. But over time, I've learned to think about valuation differently. And I think the turning point for me was the study I did for my book, 100 Baggers, where I looked at all the stocks, the best performing stocks over the last half century. And when you start to take those apart, you find that the really critical ingredient, and then there are a number of ingredients that I talk about in the book, but if I had to boil it down to just like two, I would say it's high return on capital and the ability to reinvest. So high return on capital, just intuitively, if you have a business that has $1 million in capital invested in it and is able to produce a $500,000 profit, that's a 50% return on capital. That's very good. You would pay a high multiple for a business that was able to continue to earn a 50% return on its capital. And even better is if it took that 500,000 and was able to reinvest it and earn 50% again. That's the magic. That's when you get those real big compounders. So to your question about Copart, Copart was a name that I've known about since 2011. I have research that I had written since that date, but I didn't buy it then. And I didn't buy it because I thought it was expensive on a price earnings ratio basis. But years later, as I'm telling you, I did the 100 Bagger study in 2015. Then I started to understand that you really have to think about investing in a sliding scale. So let's just take price earnings ratio. You could pay, if you pay 20 times earnings for a company that earns 15% return on capital, you might pay 50 times for something that could do 30%, right? You're going to pay more for something that returns a higher amount. And Copart was doing consistently well over 20%. So if you do the math backwards, back in 2011, and I didn't want to buy it because it was trading at 20 something times earnings, that tells you how I was thinking about it then. I could have paid up to 70 times earnings and still made 15% annualized over the ensuing decade. And the stock wound up going up 10 or 11, 12 times. So that's how you think about it. So when you look initially at some of the stocks I hold, you might look at the price earnings ratio and say, gee, it seems high, but the secret really is to look behind and see what that return on capital looks like and that ability to reinvest. And as long as they can continue to do that, it will still be cheap at 50 times earnings.
Yeah. So basically, Chris is telling us that in the earlier career, when we talk about cheapness, it was more about the price to earning, but then it's all about the return on total capital. I think you're talking about return on investment capital, ROIC.
Yeah.
And if they are very high and if they continue to reinvest, because if you have a consistent ROIC, which means that the company is able to generate phenomenal returns. I think MasterCard and Visa also come into that category.
Yeah. And it doesn't have to be return on invested capital. There are a number of metrics you could use. You could think about return on capital employed. That's another one that's good. And the return on equity would be okay as long as you remember that you have to consider leverage. The idea is to get you thinking about the returns, and then to take that return and then correlate it with the multiple. You see what I'm saying? The market's not always so dumb. And it takes those businesses like Visa and MasterCard trade at premiums because the market sees what's going on.
Awesome. So now the second question which comes in line with this, since this is the past, what we're seeing ROIC or ROC or the total capital is the past. Now, right. I think it's all about now the E, and how management can actually look ahead for the 10 years or 20 years, because we are investing for the next 10 or 20 years and continue to deliver that kind of return. And I think the macro comes in picture. That's what I want to ask you.
Yeah. Well, Bhuvan, I think you hit on a critical piece, but I would say that's really why I spend a lot of time thinking about the competitive advantage of that business, or the moat, as Buffett would say.
Yep.
Because if you have a business that's earning high returns on capital, the natural thing that happens in a capitalistic system is other people start saying, hey, that's pretty good return. Why don't I do that as well? Right? You get competitors, people who want to copy you and do something similar. And then over time, that erodes your returns. So you don't want that as an investor. That's why, again, using the Copart example, which you brought up, it's a perfect example of that, because Copart has a bunch of different salvage yards all over the country, and then they're expanding overseas as well. And it is very, very, very difficult to replicate what they've done. Impossible, because some of the land they own, you can't get. I mean, they have land that they bought 20 years ago in Los Angeles, and you couldn't do. Even if you could find the land, you're not going to get it zoned for salvage yards, right? So they have this incredible physical moat, and there's only two companies in this industry. It's IAA, which you mentioned as well, and Copart. Those are the two dominant players, and they control 80% plus of the market. And their share continues to grow because, again, it's impossible to compete with them. You wouldn't want to compete with them. So that gives you confidence that you can say, okay, they should be able to continue to replicate those returns going forward because there's not going to be any serious competitor. That's an example of the kind of thinking that you have to do with these kinds of names.
Thank you, Chris. Now that brings me to D, the disclosure. So how do you know exactly how many yards they have and where they have bought it? Are they disclosing that in the financials, or there's a difference?
Yeah, disclosure is an interesting one because that one's very qualitative, right? I mean, when I think about disclosures, I'm looking through the public filings and I'm saying, are they adequate for me to understand the business? Because I'm still a passive outside minority investor. I can't be there looking over management's shoulder every day. So I have to trust that the filings are clear. And there are some examples where, if you have a lot of related party transactions, if the financials are opaque in some way, or they're missing some details, those are red flags. So that's really what I mean with disclosures is there enough information there for me to be able to get comfortable with the business and understand what's going on and follow it.
So I think the last question on this line is, Chris, do you really evaluate each and every company on the discounted cash flow basis?
Well, if you mean, do I do like a detailed spreadsheet that shows the DCF going out 10 years? I don't do that. I don't do that because I think, I understand in theory that is correct, but as a practical matter, of course, it's very difficult to do. And you can convince yourself whatever you want to convince yourself with a spreadsheet. But implicitly, everybody, implicitly, we all kind of do the DCF because we're all, even with multiples and things, it's implied in the process, but it's an art.
Yes. So basically what happened, people ask me, oh, how big your team is, and you must be having CFAs with you. And then I have to tell them, look, investing is not a sport, it's a team sport. It's a game of individual. Let me tell all of you that Chris works alone and he literally has no employee of his own. I think, Chris, can you tell us why do you work alone? And you're not one, there are 2 or 3 more successful fund managers I know who work alone and they have at least 15% of track record. What makes you to work alone?
That's a great question. So I've done it both ways. Because when I was with the Bonner family office, I had a team and I had analysts, and there are positive and negatives to having a team. I prefer to work alone because then I do all the work myself and I know all the names myself. And, when you have a team, different people push different ideas, and sometimes, you lose your way a little bit, or you don't make it what you really want it to make. You do things maybe you wouldn't have done because an analyst persuaded you. And I like to work alone. One, I can do all that work myself. 2, like you mentioned, it's an individual sport. You really have to kind of think about the portfolio. Really is a reflection of yourself. It's a reflection of your own interests, what your own perceptions of risks are and opportunity. And you have to own it. Because you're going to be tested in the market. You're going to have drawdowns. You're going to have periods where things maybe not going so great, and you're going to have to rely on your own inner strength there and your work you did to keep you through it. So I've enjoyed it also because I think, money management, the way I've constructed, because I'm taking a long view, my portfolio only have in my portfolio, not a lot of activity. And so, long periods of quiet where I can think about things and not do anything, that's a great advantage,
So I get a lot of complaints, Chris, that I don't sell from the portfolio. This year, I think we would have just done 2 or 3 trades, and I think you would have only just bought 2 or 3 companies. So don't you get those kind of complaints, and how do you manage them, or how do you handle them?
I have not gotten any of those kinds of complaints. I think my partners, they all know, the approach, and I've been very upfront and clear with them about what I'm going to do, and they bought into that from the get-go. So I think I might get questions if I'm too active. If I, turn over the whole portfolio in a year, I think I would get some questions like, hey, what are you doing here? You said you were going to, you were looking for long-term ideas. So yeah, how I would handle that objection. Yeah, I would say, the activity is not, there's an old saying, Thomas Phelps, who wrote 100 to 1 in the stock market. He says, and he was talking about carpenters, and he says, a lot of shavings doesn't make a good workman. Just because you have lots of activity and wood shaving everywhere doesn't necessarily mean you're making something better than someone else. So I think the same is true in investing, the long-term investing. There are traders who are, turning over their portfolios all the time. But as a long-term investor, the less you do, the better off you probably are.
Friends, I think Chris is telling you that the activity outside the portfolio is very important, which we are doing today. I'm sure Chris is doing a lot of webinars. I'm doing a lot of webinars. And the activity in the portfolio will only make somebody else rich. Next time, if you feel like I'm not acting on the portfolio, I think I will gift you Chris' book, 100 Bagger, and that will be a great learning. I'm requesting all of you, be long-term investors. We are here for 100 Baggers. And that's what exactly Chris is telling as well. Chris now is stressing on the management, because now you have made the whole game qualitative. It's all about future. It's all about the management expertise. I think you also mentioned that a lot of related party transactions should not be there. Now, what kind of management expertise? Like one of the great example is Constellation Software, which we all see. How do you look into it? I know you follow a lot of people on Twitter, and you also look in the mode, etc. How exactly you go about it?
Yeah. Well, with management, that's a good one. I mean, and Constellation is a great example. So you have a number of clues that something that makes them really top-notch managers. So one is there's always track record. So you always look at that. And if you have a track record of fair dealings with shareholders, odds are they'll stay that way. I think some good flags look at compensation. Mark Leonard he didn't take hardly any salary now, but even when he took a salary, it was a modest salary. He was invested in the stock along with shareholders. So those are always good things. If you got a CEO who's just making an outrageous amount of money and not really that invested in the stock, that would be kind of a warning. You mentioned related party transactions. That can be a red flag too. If the CEO has some other company and he's using this public company as a piggy bank to pull cash out through related party transactions, that would be something questionable. So you don't want any of that kind of stuff. You want a clean, a fair compensation system. Another thing I like to look at is the share count. One of the most remarkable things about Constellation is they have the same number of shares outstanding as they did when they went public. It's very rare. And so with their employees, they have to buy shares on the market. And that's actually part of their compensation plan. So that's a rare situation that you would find that almost all public companies will have some increase in their share count over time, some mild dilution. But, I like to see a management team that's protective of their shares.
So just to summarize, Chris is saying that the most important thing to look into the financials is the related party transactions, the fair compensation where the management has been honest. I think one more thing which we can do, Chris, please let me know if I'm right. You can look at the past, what management has said, and whether they have delivered that or not. So that's a very good thing about management being honest. Having said that, return on total capital and all, they basically tell all about the management anyways.
Yeah, and the consistency of that message as well, right? Because if they say, they keep repeating they're doing one thing and then suddenly, they change their tune, that's always a red flag. You want to have some consistency in that message and in the way they think about things. And that's important as well.
So coming to the question of the dilution. Now, I think dilution is very common in all the growing companies. Now, don't you think that return on total capital addresses that?
Return on capital? Yeah, because you're going to be adjusting for, as long as you're adjusting for the increase in shares. I mean, I have a couple of companies where their share count has gone up quite a bit because they're growing rapidly, like you say, and they've issued some along the way. In this particular case, to do an acquisition that made a lot of sense. So, a lot of times in investing, we don't have these hard and fast rules. Like you say, I'm not going to invest in a company that has more than 2% dilution. You have to look at everything in context. Does it make sense?
I'll actually note that point because I've seen this dilution happening. And the major reason is that when you hire new people and you want to give them employee stock option, I think you have to dilute the shares. Am I right?
Yeah.
Yeah.
Yeah, that happens a lot, especially with tech companies. And again, it may be okay. I mean, it may be that the growth is far surpasses the mild dilution you get. They have to do it. And like you mentioned, your return on invested capital, you're going to have to take into account that dilution when you're thinking about the future returns and what's reinvested in the capital. You just have to know that the share count, you have to account of that, build that in your thinking that the share count is going to grow in the future as well.
So the second question I wanted to ask you about the free cash flow divided by market cap.
Yeah.
Now, I've seen many of investors or the fund managers, they use it. So let's say the 10-year treasury of the US is giving right now, let's say 1.5%. And if let's say a company like Copart or Amazon, or for that matter, Evolution, which are giving 2, 3, or 4% return, is it also one good criteria to see they're cheap?
It can be, but again, free cash flow yield doesn't take into account those return on capital that we talked about before, and it doesn't take into account the reinvestment. So free cash flow yield is really, it's a fancier price to earnings ratio, right? It still suffers the same limitations. You don't know about quality of the balance sheet by just looking at free cash flow yield. You don't really know about competitive position. You don't know about how much capital they require to produce $1 of free cash flow, and you don't know about their ability to reinvest that. So sometimes a 2% free cash flow yield can be cheap, and sometimes it can be expensive. And it depends on those variables, in particular, the ability to reinvest and that return on capital.
Right. So here we are, basically the investing is not a perfect science. And you can't just have one metrics and you can decide that this company is good for you. You need to look at a lot of parameters, and it is, I think, part art, part science. That's what I really wanted to say.
Yeah, and I'll also say also depends on what kind of style you are. I mean, there are people out there that are quants, right? Quantitative investors, and they have big portfolios where they might have 100 names, and they're just looking at low PE and a combination of this and that, or whatever their combination is. And that can work. But for the approach that I'm pursuing, which is more similar to the approach you're pursuing, we want to own great businesses, and we want to own them for a long time. And we don't want to own that many. So, in my case, I have 10, but probably ideal, I would say, it's like 10 to 15, something like that. And we want to be able to hold them. We want to have those 100 baggers, 50 baggers, 10 baggers. That's what we want.
And the one is enough, I believe.
One is enough. All you need is one.
Yes. So, Chris, we have a hypothetical situation for you. Let's say a company with a market cap of $2 billion. It is in the e-gaming business with $1.6 billion net cash on the balance sheet. Revenue, the past revenue has been growing by 30 to 40% year on year. But in the short term, company has been hit by the regulatory pressures, which have hit the stock price very, very low. It's very cheap. The company is in one of the two in the market when it comes to the e-gaming. How will you assess this kind of company? Will it be a company to look forward in your competency, or you will even ignore the company, even if it is dirt cheap?
Well, if it's dirt cheap like that, there may be something seriously wrong with it. So I'd have to really spend a lot of time understanding what that is. And if it is truly temporary, then I think that could be really interesting. I also think that, when companies have a lot of cash like that, that's also something to ask about, because a company that carries that much cash, it's really, it's like a dampening of the compounding. I mean, it makes it much more difficult to come around that much weight in cash. So I'd want to know, why are they carrying that much amount of cash? What is their plan for it? So those are two critical things I would start with right away.
So I think the most important point, so we hear two schools of thought. We're also learning in the investing field, and a lot of cash in the balance sheet can also be harmful to the company because the cash is not being used, and it is going to affect the total compounding. And so a lot of cash is also not good. A lot of debt is also not good. So investing is really not easy. That's what I can understand from the conversation.
Yes. Also, the context is important. It's very important.
So Chris, has it happened that you bought a company and you're entirely convinced about the opportunity, and it has happened that you could not buy that company because it has not met your target price or the buying price. Any regrets that you
Sure.
have?
Sure. There's been lots of things that I have would have liked to have owned that have well, there's been things that I've had to pass on because it didn't check my box for one reason or another, too much leverage or lack of an insider. And then I see the stock has done very, very well. And that's always a little painful, but I mean, that's part of the process. You're not going to get them all. You're going to miss a lot. And the purpose of building filters, like I mentioned the code before, is that it helps keep you out of trouble. I mean, it's a way to kind of filter the investment universe because there's so many names, there's so many ideas. You have to have a way to bring them down to something manageable that you believe in and you think these are important metrics and go from there. So you have to be willing to, yeah, you're not going to get everyone and you're going to miss it. And sometimes you're going to think, gosh, I make a big deal of, I want to have the insiders, I want to have people with skin in the game, but here's one where that hurt me, because the stock just continued to go way, way, way up. Yeah. That's part of the investing. So you're not going to catch all the fish.
So I think regret is the lifetime disease of the stock investor. So be with it. Don't think much about the past. Focus on what you have right now. And
yeah, I've also had names where they've checked out all my boxes and then I wanted to wait because, as you say, maybe the price wasn't where you wanted it to be, and they just keep going and going and going. I mean, it's very frustrating. I can think of one in particular. I wrote about it on my blog. I did a lot of work on it. Loved the name. Checked all my boxes. It was Old Dominion Freight, ODFL. It was about $125 a share when I first started looking at it. And I think today, that was probably maybe 2 years ago. And today it's $300. And I sit here, keep watching it. Why? It's very frustrating. But that's, again, part of it. I mean, you can't keep chasing ideas. You have to have some discipline. And you have to recognize that it's going to mean you miss some things, but that's okay.
Yes. Now I have a counter question. Now I'm talking about the inside the portfolio. Now you have a company which ticked all the boxes and you bought it, and then it did not perform.
Yeah.
Is it happened with you? What did you do with that company? If we can know the name, and how did you, the overall you corrected the mistake, if at all it was a mistake?
Yeah. Well, one that checked all the boxes. Yeah, I mean, not worked. It's different when you say not work because we have to separate. There's the stock price and then there's the business. So there can certainly be times where I own a stock and the business seems to be going along fine for me, but then the stock doesn't go anywhere, or even down. I have a stock. I'm thinking of Hayakawa, which the business has done pretty well, but the stock has barely moved for the year. And I'm not really concerned at all because I know that eventually it will, the stock price will follow the fundamentals. So over a long term, but for a year, even longer, you can have those disparities. But that's why people like us are in business. If that didn't happen, we would be in trouble. If the stock price always matched exactly what the business was doing, then we wouldn't have much to do. So that's important. And then, for a business where something fundamentally happens with the business, that's more important. And this doesn't matter where the stock is at that point. If the stock is up or down, doesn't matter. I will get out of such a name if I think that I have made a mistake or that, something I believed about the business proves to be incorrect.
So here's a very good lesson that a stock which you have in the portfolio might not perform for a year or two. Be patient. I think the minimum is Warren Buffett say minimum is 10 years. Mm-hmm. I will say at least 5 years you should be in the stock to evaluate whether you have taken a right judgment or not. But if the financials are good, the business is doing good because the wealth creates in the business and it just transfer to the stock. So yeah, that's the message what I'm just simplifying for all of you. Now, let's talk about the sector investing. I know you do not write a single sentence about the macro. I've never seen you on Twitter writing about the interest rate increase or tapering. Though I'm very lucky that you have written that in the book. So, and I was very lucky I basically follow Kenneth Fisher, and he said that tapering is it's basically not dull, it is basically good for the companies because there will be lending, and the lending will help the people to spend, and that's how companies will have good profit. Now, the question to you is, before I ask the question, let me also tell you, if we make a chart of tenure on the S&P 500 index investing, it has been seen that the IT companies have outperformed, followed by the financials and healthcare, and then comes the index itself. Do you have any sector focus in your investing, or you're absolutely nothing to do with the macro aspects of the economics?
Yep, great question. I say I do pay attention to sectors because, well, one, from a portfolio standpoint, I'm careful about taking on two companies that then wind up being the same risk. Maybe if I already own Copart, then I'm not going to own insurance auto auctions as well. Or if I already have Heiko in the portfolio, which I know is tied very much to aerospace, I don't want to have another aerospace aviation name. I'm trying to keep buckets of risk separate. And so to that extent, I pay attention to sectors. I think, when it comes to the macro, you pay attention to it. But I think the difference is I'm not trying to predict it. So in other words, I take interest rates for what they are, and they're very important in determining valuations of companies. But I'm not going to build a portfolio around the idea, say that if I have this idea that interest rates are going to go up and there's going to be inflation, I'm not going to build a portfolio that's all around that idea, because what if I'm wrong, right? So I just want to make sure when I'm constructing a portfolio that I have a balance of risks and that I'm not taking one macro bet, either knowingly or unknowingly. If you have a bank and then you've got an aircraft leasing business and then you've got an asset manager, you might think they're all different, but those are all similar asset, interest rate sensitive names. And unknowingly, you're building a portfolio that's very interest rate sensitive. So you want to consider all those different risks. That's one reason why, too, I like to invest abroad, because you can take different country risks. You can, you can spread things out a little bit differently and build a portfolio that's resilient in a lot of different macro environments.
Great. So now let's talk about risk more. So one aspect which you just mentioned is that when it comes to the portfolio, you definitely want to have different sectors to make sure that all are not privy to the interest rate or the financials. What about the country specific risk? And tell us more about how do you mitigate the risk on the portfolio?
Yeah, so that's good. I mean, country risk definitely is something I think about. So some small countries, I maybe don't want to have too much exposure to. Let's say, I don't know, actually, the interesting thing too about geography is that a lot of businesses are global. So, Evolution is in Sweden, but is it really a Swedish company? Does it depend on the Swedish economy? Not as much as you would think. It's a global business. I mean, the US is important, Greater Europe is important, Asia is important. So, there's that difference. But sometimes you have a business that is really only domestic. Maybe it's a pizza business in Poland and it only serves Polish market or something like that. In which case, you have to be more conscious of, that risk of that particular country. The other thing about investing in different countries is
exploring the world in the search of investment opportunities. In your opinion, what are the markets that look attractive? So when you went there, and how did you do that? I'm sure Jim Rogers has also done that.
Yep.
One of the legendary investor who has traveled literally on bike with his wife in the car in the whole world. So how that helps in investing?
Well, my travels have really helped inform my investing. So I've probably been, 40 different countries, all through Asia, all through South America, visiting companies. And I have to say, in the book, some of those ideas, really did not work out. And some of them really did work out. But it was great to learn how to visit a company in a place you've never been, and understand it and talk to people and fit it in its ecosystem and learn about the competition history. It's a lot of fun to do that. And so that experience carries over now. But I think about it a little differently in one respect, is that, back then, like you were saying, I was looking for a good market, like an appealing market. So somebody might say, well, is there a market around the world that particularly looks good? And you will say, oh yeah, I'm really bullish on, Greece or whatever. I don't think of it like that anymore. I'm just much more company specific. So
Yes.
I don't necessarily care that much about whether a particular market is attractive or not. I'm more interested in those individual names and the economics of those businesses and the markets that they have that they can potentially grow into.
I think you have already hit the nail earlier when you said that a company listed in the, let's say, for example, Evolution Gaming in one market, but it's actually not that Sweden. It's basically across the world. It has been delivering their products. For example, Amazon, for that matter, is growing not from America. It is replicating the model of America, which is created there. I think same goes to Copart as well.
Yeah, and sometimes you have really weird examples, like another company I have in the portfolio is called Topicus. It's listed in Canada, but it's basically a Dutch company. Everything headquarters in the Netherlands, everything is over there, and so you really have no connection between seemingly where it's listed and where it does business. So it's an interesting world we're in that way.
Absolutely. So, friends, the message which is very important to you: it doesn't matter whether you invest in any currency or it is listed in a particular market. What's important is what is business doing, where it is growing, and how it is growing. And that's what you will never get on the Yahoo Finance. For that, you have to really be a good researcher. You have to be inquisitive about it, and then you have to give it full time. Am I right, Chris? You want to add something there?
Very well said. Very well said. Can't say it any better than that.
Thank you. So now you have also bust the myth of growth and value investing. And these are two schools of thought which goes on. And I'm sure Warren Buffett has his piece of advice, which I understand. Let's hear from you. And why do you feel these terms why they are very differently perceived by people?
Yeah. I mean, for me, I do away with that entire distinction between growth and value investing, because they just seem like words that people have put together and used to describe different sets of companies, but it's a very blurry line. What's a growth company? What's a value company? And, I think Buffett has said that growth is the component of value. You can't really, that's the intuitive, obvious thing. And so I don't see what benefit it does for anyone as an investor to think in terms of, well, I want to be a growth investor, or I want to be a value investor, or here I want to have growth investments and here I want to have value investments. I mean, they should just be the best investments you can find. Don't worry about what you're going to call it, and so that's why I spend a lot of time in How Do You Know, dealing with those kinds of questions. People talk about growth and value, momentum, and they use these terms, and they're very imprecise, and I don't think they help you become a better investor.
Thank you. Now I have a question on Lindsay Effect. I think the Lindsay Effect, you call it.
Yeah.
And one of your blogs you have mentioned it, which is and how it is applied to business. So let me behave as a layman, and I don't understand it. Can you explain to me what is it and how it can help me to be a good investor?
Yeah, well, the Lindsay Effect in a nutshell is simply that something that has survived for a long time is more likely to survive going forward. That's really it in a nutshell. Very simple. So something that's been around 100 years is more likely to be around next 100 years than something that's only been around 5 years. That's the Lindsay Effect. Okay.
So are we saying that business like GE, which has been for years for so long, are you saying that they are on the right side of the Lindsay Effect or on the wrong side of the Lindsay Effect? That's what I want to.
Yeah, I know you were going to go there. That's a good question. So the Lindsay Effect as a general rule would say, that the older company is better, has a greater chance of surviving. But of course, that has been disproven in lots of ways, right? I mean, look at newspaper stocks, we can think about, Kodak and Polaroid and these stocks that have been around a long time, and those businesses have suffered. So like a lot of things in finance, as we were talking about before, there's no absolute rules, right? And certainly somebody like Amazon, even though it's not as old as many of the old companies that are in the Dow, I think we would agree has a much greater chance of surviving than some of those. So the Lindsay Effect, though, as a general rule of thumb, is it makes you think anyway. It makes you cautious. If something is new and hasn't been around very long, you should know in your mind that overall, those kinds of things may not survive. And something that has been around for half a century probably has there's something about it. That's really what I think the Lindsay Effect makes you do. It makes you kind of directs your questions. Something has been around for 50 years and it's done really well. Well, why? There's something special about it. What is it? As an analyst, that's what you have to find out.
So, Chris, a question to you is, what is and I need an answer in a number. What is the minimum duration of a company which is required for you to touch?
Well, I always have this thing, I say about a decade.
Okay.
If I get a good 10-year look. Now, there's exceptions because, for example, I got a spinoff. So the spinoff is brand new.
Yes.
But, that's okay. It comes from a company that's been around a long time. Now, again, am I going to say no to some company's been around for 5 years, but checks all my boxes? And let's say it's in a business I can understand and something that makes sense. I'm not going to automatically say no because it's only 5 years old. But as a general rule, yeah, I like these things that have a little age on, have been around a little while, and also helps in the analytical work, and that gives me some track record to dig into. If I got a decade, that's probably a pretty good sample.
Okay. So when you say a decade, it is being listed at 10 years or just?
Nope.
Okay.
Doesn't have to be listed. Could be private. Yeah.
So friends, minimum 10 years for a company. I think there's a famous book called Ultimate Sales Machine by Chad Holmes, and he said that 96% of the companies fail in the first 10 years. And by doing this exercise, you protect your portfolio against any odds. And that's what exactly Chris also practiced. We also in a similar line. There are exceptions, 5 to 10% of the portfolio, which is absolutely fine. Now, Chris, let me make it very simple for my audience, and let me ask you a simple question that people who do not know how to invest and they want to invest and make 15-20% in a year, what they should do in your opinion?
Well, they got, investing is a path of books and learning. So there's a lot to read. Some of the early things that I read that helped me a lot was Buffett's letters. Peter Lynch's books are very good.
Awesome.
And, his books are really good for kind of an amateur stock picker because he emphasizes to invest in what you know, businesses that are around you, products that you already use, and to look up those companies. I like to think my 100 Baggers book is helpful in helping giving you that framework. So yeah, those are some books to read. You got to start with those, kind of start to train your mind to think like an investor.
Since you have mentioned about Peter, I think his life has been very tough because of being a fund manager, you have a lot of challenges and you have to perform every year because he was a public fund manager with a lot of money. And in a commercial role, definitely you and I have chosen a path there where we are basically out of the commercial setup and we don't want to deliver it year on year. But where I think Peter Lynch has really done a great job, friends, you must read the book. And now since Chris has taken the name, I will definitely tell all of you that Peter Lynch has done a very, very good job in the stock investing, and he has simplified. And I think he should be also glorified as Warren Buffett has been. And he's done a fantastic job in the field of investing. So a new investor who want to invest, let's say $100,000, should he come to you or not? Will you accept the money or not?
I wouldn't accept the money, no.
You'll accept it, right?
Yeah, well, no, I won't. My fund is $1 million minimum. So that's,
okay.
And it has to be the right person anyway. Even if you had the check, I'd have to spend some time to know you and make sure you're aligned with what we're doing. So that would be important. But 100,000 is a good sum of money. And, I'm tempted to say, there are other solutions for that amount of money. I'm tempted to say, like an index fund would be a reasonable starting point, or some sort of ETF. But you can always take some small portion of that money and take 3 or 4 stocks that you know. I have my microphone tipped over. I have two kids, and I got them brokerage accounts pretty early. So my daughter owns Disney, and she owns Etsy. Businesses she knows, and my son owns Domino's Pizza. And that's a good way to, to learn. Take just a few companies of things that you know and like, and start to read their annuals. You start to get a sense, and you can tiptoe in.
So friends, here the lesson is, if you would like to invest with Chris, he will also choose you because he also want to look at your temperament, and that is the reason he has left the corporate life behind, and he works all his own, and he basically spend a lot of time in writing. And this is what the kind of people you should look for when you're investing, because you meet people every day. The bankers come to you every day, hungry for your money, and they tell you that we will not even charge you profit sharing, and we'll only charge you a custody fee and a small fee, but they keep churning your portfolio. We have been part of the story, and the churning will basically make you pay roughly 20 to 30% of your profits, and your profits will not be in double digits. I'm sure you all know it, and that's why you are here. So here is a man who is so known in the field, and you can interact with him and definitely take your investing journey ahead. Chris, can you tell us more about your portfolio and how it has been doing? How has been the 19 and 20 and 21?
Yeah.
Really feel free.
Well, portfolio, we started in 2019. I was slow to put the cash to work, so I kind of carefully picked through names. So it was off to a slow start. I think it was up about 12.5% net for that first year. And then 2020 was COVID. And, I had oil and aviation, so that was definitely tough for me. Finished the year about flat. And then this year is a good rebound year. So we're up about probably 40% or so far this year. So the 3-year compound return for the fund is somewhere around, close to somewhere in the 12 to 15% range would be, and that would be fine. I've told my investors that if we do 12 to 15%, long term over 20 years, we will be very, very happy. And so the portfolio, as I say, it's fairly concentrated. I have 10 names now. The biggest name is 11%, and that stock is a stock that has doubled. So it's not as if I, made it 11% right off the bat. It's a company that's grown into that position size. And that's another thing when we talk about risk. My kind of internal risk parameters, I don't go make anything more than 10%. Once it's 10%, then I stop adding to it. But the portfolio is very well balanced. So it's got 10 names, and probably the top 6 names are probably all right around 10% or close. 60% of the portfolio is in those top 6. And so these are names that I intend to hold for quite a while. I always find interesting things to add. So this year, as you mentioned, I've already added 2. And I took out 2.
Okay.
So
these 2 companies which you took out, is you've booked massive profits, or you felt dynamics are changing now?
One was I took some profits. I got rid of Intercontinental Hotels, which was one that was very painful to own in 2020 when the whole pandemic was hit, and Howard Hughes Corp. And that was another one that was very painful to own in 2020. It went from $135 to $35. But I took out those, and the amazing thing is that Howard Hughes even today is still about where I sold it, and I used that proceeds to buy Topicus, which is doubled, and then I let Intercontinental go, and I picked up Evolution. So this is another important thing to know, Bhuvan, which is that when I sell something, I always want to upgrade it, right? I always want the portfolio to be upgraded. And so I'm very happy about that the 2 names I added in terms of quality, the things we talked about earlier, return on capital, ability to reinvest, that the 2 names I added were clearly well above names that they replaced. And so I also think about that in the long term. If I'm always doing that, if I'm always finding something and replacing it with something that's demonstrably better than what it replaces, then the portfolio over time is only going to get better. And that kind of stuff makes me excited.
I think, Chris, that's very well said. Even the reason we talk to you is the same thing. We also want to improve every day. And if this event would have not happened, neither we would have bought this book, nor we would have written, nor we would have known more about you and your investing approach. So when we start, we all want to buy cheap, and let's say we make 20, 30, 40, 50%, and we want to sell and we want to feel happy. But during the time, we realize that we can't be spending our life looking at the ticker or the mobile by 12 o'clock or 1 a.m. in the morning.
That's right.
So there is a very good saying that every day I will make the Dow sleep.
Yeah.
and then I'll wake the Dow wake up. And I don't think so people want to do that. And
Right.
at least I don't want to do that. I know you might miss 5, 6, 7% return, but a good balanced life is very important because you need to compound the wealth, and the compounding effect is much, much larger with the time.
Very, very important. That's
Yeah.
very important.
Like,
And that's a weakness in that strategy when people, you look for 30, 40, and then you take the profit. Well, then what do you do? Then you pay taxes. Then you find another idea. Maybe the other idea you make a mistake, and then, or whatever. Maybe you make another 20%, but then you got to sell it, and you got to find something else. I mean, it's a very hectic life where you're just constantly churning through tickers trying to find these little, cuts. Versus if you just own something that you think about you're going to own for the next decade, and you just own it, you get to know it really well, study the business, and then hopefully at the end of those 10 years you're up 5x, and it's been a much smoother, better journey and a better life, as you mentioned, than constantly trading for 20 or 30% or 40% gains here or there.
yes, Chris, I think we have 5 minutes more before we leave, and you have a beautiful library behind you, and you have been a voracious reader. Let me tell all my audience here that Chris has been reading a lot, and you can join him on Twitter. Definitely a great piece of advice and news. It is nothing related to the macro. It is specific to the companies and the learning behind that. So Chris, would you like to take us through your library, maybe 2 or 3 great pieces, apart from your own writing, what one should read?
Yeah, well, right back here, I have a lot of my investing books. And so Peter Lynch is on that shelf. 100 to 1 in the stock market by Thomas Phelps is another favorite of mine. There's a book there on concentrated investing, which is interesting. In the middle here, I have, here I have some of my philosophy. Alan Watts is a philosopher who talked a lot about Zen and Eastern philosophy. I'm Alfred Korzybski here, my general semantics books. A lot of my philosophy books over here, and they're all in order, basically. So at the top, I have Plato and Aristotle, and then it kind of goes down into, Spinoza and David Hume and Enlightenment philosophers, Schopenhauer and Nietzsche. Here I have collected works of Carl Jung. And right in front of me, I have my Bhagavan works. My Ramana Maharshi is very important. Very, very important philosopher for me. Very most important, I'd say.
You stole thunder out of my second question.
Is that right?
Yes, because how many interviews I've taken, it's all come to the spirituality at the end of the day.
Yes.
Yes. So, and I was about to ask you, and you took Raman Maharshi out, and you showed all of us. So I think if we go back to the spirituality again in this case as well. Friends, I've been doing these webinars, and I will tell you one thing: all these great investors are spiritual in life because they know it's not them. It is definitely not them. It is just through them. And I think Raman Maharshi is all everybody knows in India. In fact, he has spoken very less, and he has written, I think that I forgot the name of the book. He's written 16 verses, and that sums up the whole Bhagavad Gita there. I have gone through that. So I'm very, very delighted to know that you also have a spiritual path. Something more about India, if you could tell us. What has admired you, and how did you meet Raman Maharshi, by the way? I'm sure you would have not met him, but how did you come to know about him?
Yeah, that's a good question. So I've always been interested in these spiritual questions, like you say. And it was Alan Watts, actually. So the philosopher I mentioned before, I really like to read his works. And like I say, he writes about Zen and Taoism, and then he wrote about Vedanta. And he mentioned that he mentioned Ramana Maharshi then as a master of Vedanta. And so after hearing him talk about it, I was like, well, I have to look this guy up. And so the first book I got was Be As You Are, which is edited by David Godman. And it was a book collection of his talks and things, and it was arranged thematically. And that book blew me away. And I was hooked ever since. So now, but you can't see it because it's right behind my computer screen, but I got 2 shelves full of
Maybe next time you can sit like this and we can.
Right. From the ashram, books about him, by people reminiscing about him, and so that's once I've discovered him, I had found my guru. I could say I really learned a lot from him.
Great to know that. I think one session is not enough. We have to invite you again and again, but for that we also have to read a lot and be worthy of your time. Thanks a lot for being with us. I think in the event of time, we need to end the session. Friends and investors, please feel free to approach me. This is an education session. I have no commercial gain whatsoever for being Chris here. I think we are doing great. He's doing great. We all have left our corporate life for you and for ourselves. Feel free if you would like to have, rather than having one or two fund managers, you would like to have 3 or 4 or 5 fund managers and get your money compounded in a very ethical and in a very, very peaceful manner. Then I think this is for you. On that note, Chris, have a great day there. Thanks for joining us.
You too. Thank you, everybody.
And great evening. Good evening, guys. Have a great evening. Please drive safe home. I'll see you again, Chris.
All right.
Thank you. Bye.
Thank you. Bye-bye.
Yeah. Bye.